There are a variety of deposits that roll down cyclically in the second quarter as people pay their taxes, and we've had some other specific things that we've done with certain types of deposits that don't create a lot of value for the bank that we shrunk earlier in the year. On the loan side, we're growing in the areas where we want to be growing in business loans, first mortgage loans, credit card loans. There are some commercial real estate categories where we've been a little bit more cautious, and that's slowed down. Auto is something we slowed down a few quarters ago, and then we've got some runoff legacy single-family real estate loans that, on balance, shrunk the loan side a little bit this quarter, but there's growth where it could be and should be. We've got plenty of capacity to grow more loans if the market gives us good risk reward, but as we described, there are certain categories up and down in the quarter.
How much of it is, John, related to fallout from the fake account scandal a few years ago, whether it's reputational harm to the business or regulatory payments?
Yeah, so there are some loan categories that were slower to recover over the last year or so because we weren't getting the type of referrals out of our branches that we historically would have. But whether it's first mortgage loans or other personal loans and lines or even credit cards, those actually look pretty good year over year in terms of their growth rate. So I wouldn't really ascribe it to that. Some of it's just where we are in the cycle for credit on the loan side, and some of it's where we are in the cycle for rising interest rates and both high net worth as well as corporate customers putting what would have been bank deposits into money market mutual funds or other cash equivalents, or companies actually just spending some of their cash as they grow a little bit in the first quarter. So in terms of how the balance sheet looks, I don't ascribe much of it to the account problems of 2016.
Well, you mentioned where we are in the cycle as you know, one input for how the quarter went. I do wonder about how investors are viewing that in general for the banks right now, because obviously the entire group has been an underperformer, and it seems like there's an overlay of concern that, well, maybe this is as good as it gets for things like credit losses and even for profitable loan growth, and of course on the deposit side now having to compete a little bit more for customer deposits. So is that the case right now, that maybe things are going to slightly get tougher from here, or we have good runway?
Those are good points. One other thing I would add is that going into the end of the year, most banks were priced for perfection based on the euphoria around tax reform. So they finished last year at very high levels, and if you're comparing performance this year versus the 12/31 close, that's an important thing to remember. I would say on loans, credit has never been better, and so while it doesn't look like that's going to change in the very near term, you know, through the cycle loss rates are probably likely to be higher for everyone than they are today. On the deposit front, especially for big banks, deposit costs have remained very low, especially among core consumer deposit franchises versus where most people would have expected them to be at this point in the tightening cycle. So there's been a relative outperformance on that front. And while I don't see that abating or correcting anytime soon, that advantage is still there. If you're thinking about mean reversion or you know, other long-term performance characteristics, you'd expect deposit costs to be higher. So having said that, the transactional activity in our business, credit card activity, debit card activity, both of which are fee generating, new account creation with people who call us their primary bank, have been growing nicely. First mortgages growing nicely. There are still a lot of strengths, but on loan growth, I would say most customers have remained a little bit more wary of leverage. They're a little bit more cash rich than they might have been going into the top of the last cycle, and so it doesn't feel at all like it did in 2005, 6, and 7. I don't think we're at that point in the cycle.
I just want to quickly ask you about your capital return, which you just voted to massively increase. What was the thinking there? Is it because you can't use your capital because of the Fed's restrictions on the balance sheet growth?
Yeah, so we had our capital plan unobjected to a couple of weeks ago, and we're going to be returning $24.5 billion through share repurchase over the next 4 quarters. A couple things going on there. We earn a lot of money and we generate a lot of capital, and that's been true through thick and thin over the last several years. So we've been accumulating excess capital for a long time. Our risk-weighted assets haven't really changed much and won't really change with or without the Fed's asset cap. That's more, frankly, about leverage assets, non-risk-weighted assets that make the balance sheet bigger. And so we've managed risk-weighted assets well. We don't have very fast loan growth or other risk-weighted asset growth just because of the risk reward of the environment that we're in, have a lot of excess capital, and we'll be returning it over the next 4 quarters.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.